Please be seated. I now invite the students of Madras School of Economics from both programs to present samples to the dignitaries. Thank you. I now request our chairman, Dr. Ramarajan, to present the memento and shawl to our speaker of the day, Dr. Ashima Goyal. Before that, we have the welcome address. I invite the director to deliver the welcome address.
Good afternoon, everyone. Dr. C. Rangarajan, Chairman, Madras School of Economics, Mrs. Satyabhama Subramanian, and family members of Shri Kandaswami Endowment, and our speaker for the day, Professor Ashima Goyal, other invited dignitaries who are part of this event, my faculty members from Madras School, and my dear friends. It's indeed a very important event in Madras School of Economics. As we all know that MSc has a tradition of hosting many lectures, endowment lectures. This year, we have a new lecture under the series, which is supported by the family of Shri Kandaswami Subramanian. And there is a citation about Shri Kandaswami Subramanian, which will be read out later. But with the support of the family members, we instituted endowment lecture this year. And we have today Professor Ashima Goyal giving the first endowment lecture under the series. I'm sure many of you know about Professor Ashima Goyal. Currently, she is Emeritus Professor at Indira Gandhi Institute of Development Research, Mumbai. Dr. Goyal has widely published in institutional and open economy macroeconomics. In fact, she is one of the early members who started research on open economy macroeconomics, even before India opened up in a big way. We, as the students of economics, we read her works in the open economic macroeconomics and international finance and also on governance, with more than 100 articles in national and international journals. She also authored and edited a number of books, including Macroeconomics and Markets in Developing and Emerging Market Economies, and a concise handbook of the Indian economy in the 21st century. I think the students should read this concise handbook. It's a very really concise in my view. I think you should read all that book. She edits the journal Macroeconomics and Finance in Emerging Market Economies, has provided consultancy to Asian Development Bank, Department of Economic Affairs, GDN, UNDP, RBI, UNSCAP, World Bank. You have not left any other institution here. She is an active in the Indian policy debate and has served on several government committees, including the Economic Advisory Council to the present Prime Minister, the Reserve Bank of India Technical Advisory Committee for Monetary Policy, that's the previous avatar of Monetary Policy Committee, boards of journals and educational financial institutions. She just completed her 4-year term as a member of the India's Monetary Policy Committee of Reserve Bank of India. She was a visiting fellow of the Economic Growth Center, Yale University, a Fulbright Senior Research Fellow. Her research has received national and international awards. She won 2 Best Research Awards at GDN meetings. And I think that's not on international finance, that's something on gender, if I remember correctly. And she was selected as one of the 4 most powerful women in economics by Business Today. And she was the first Professor P.R. Brahmananda Memorial Research Grant awardee for a study on history of monetary policy in India since independence. Hindu College Distinguished Alumni Award, Delhi School of Economics Distinguished Alumni Award, and Promising Women Leaders of India by Economic Times. I think there are many other organizations who say she is the most powerful woman in the country, in economics. So I don't want to read out all that, but and we all know she is a regular columnist in the Business Line and other dailies, like Shri Kandaswami Subramanian. He used to write very regularly in Business Line. And his interest was also more on international finance and open economic macroeconomics. And it's only befitting that she's giving the first Shri Kandaswami Endowment lecture today. So welcome you to this lecture, Ashima Goyal, for this event. We also welcome Mrs. Satyabhama Subramanian, a retired IAS officer. She retired as Agriculture Secretary to the Government of India some 30 years ago. And she was also served as a collector of this place where we are sitting right now. One of the early jobs was she was a collector of this district. So welcome you to this event and the family members also. We also welcome our chairman, Dr. Shri Rangarajan, leading light. I hope I think I should not do that introduction. We all know what he is and what is his contribution. Chairman of Madras School of Economics, former governor, Reserve Bank of India, former governor of Andhra Pradesh, chairman, Economic Advisory Council, Prime Minister. So there are many more, and he continues to contribute to this nation in a big. And I also welcome all the faculty members and other invitees. I see many people from outside, and also students from Madras School of Economics for this lecture. Thank you so much.
Thank you, sir. I now invite our chairman to present the memento and shawl to the speaker, Ashima.
Like this.
I request our director to present the memento to Mrs. Satyabhama Subramanian. Thank you, sir. Thank you, ma'am. I will now read the citation of Shri Kandaswami Subramanian. Shri Kandaswami Subramanian, 12 to 1932 to 28/8/2023. Shri Kandaswami Subramanian, a postgraduate in economics of the Madras University, spent his professional life mostly in the Ministry of Finance, Department of Economic Affairs, and retired as Joint Secretary to the Government of India. He was known for his impeccable integrity, fearless expression, humane approach, and devotion to service for public good. His advisory notes on several issues were sought after by colleagues and peers for clarity, comprehensive analysis, and perceptive presentation. Subramanian was versatile with deep interest in subjects ranging from literature, theatre, music to science, history, and philosophy. He had a vast personal library of books, His standard novel, published, sought to reprints from literature groups in Tamil during 2022 and 23. Post-retirement, his passionate interest in economic developmental issues continued. His reviews and articles appear regularly in major English newspapers and other publications, including the Economic and Political Week. He was also a founder member of the Chennai chapter of China Studies, participating in discussions and presenting papers at the center. This endowment is to honor his contribution to public service. I now invite the speaker of the day, Dr. Ashima Goyal, Emeritus Professor at IGIDR, to deliver the endowment.
Thank you, everyone. Thank you.
One thing.
There's another one, I could use that now.
Think of stars then. So should I?
Dr. Rangarajan, Dr. Bhanamurthy, Mrs. Subramaniam, and faculty and students. It's really a great honor for me to deliver this first Kandaswami Subramaniam Endowment lecture. And it is very nice to be here, especially because IGIDR, I see a lot of old IGIDR students, ex-IGIDR students, and it's nice to be with such a vibrant group of young people. The topic I chose was specifically when I read about what the perspective that Shri Subramaniam had. He seemed to understand that local issues require special analysis. And very often that is missing in the debate. So I thought I would draw on, that is a perspective that has informed a lot of the research I have done in my position on many policy issues. So, since in this lecture we're focusing on macro, monetary, open economy issues, so a transitional emerging market like India is not in a steady state. And here, macroeconomic policy has more impact since it affects growth. We know that many NPCs in other countries talk about unemployment and inflation, but we already make it growth and inflation. And we know in transition, growth tends to be much higher than it is in steady state advanced economies, where there's fluctuation around the steady state rate of growth. Now, the growth itself is volatile and affected by macroeconomic policy. But unfortunately, my interaction and understandably, when you're at low per capita income, development is the major issue. And a lot of policy often focuses on these structural issues, getting over developing, rather than macroeconomic stabilization. And overall, the dilemma is that you're opening out, you want to develop, you want to become a developed economy. So you advise, especially from market analysts, and another reason I'm happy to be here is that I've been interacting a lot with analysts recently. Even MPC had to do that with press, and because it was a difficult time, we were encouraged to talk to them, to tell them what is happening, etc. And they really have a very superficial understanding and very US focused and do not really understand Indian issues. And very often the big battles we had were to explain some of these. The problem is that what developed economies are doing is not adequate for us. But we want to move from a past where there was too much intervention, markets were choked. So it's natural to think that we have to become like the advanced economies, but we are not there yet and we can't act like they are. And in some ways, it's not good for us to become like them, because I'm going to argue that sometimes what we are doing is somewhat better. So I think this is an issue that Shri Subramaniam understood well, and he used to analyze events and policy from the Indian perspective. So just a recent example, I think that the flexible inflation targeting, the MOU that the RBI wrote with the Ministry of Finance, has worked very well for India. But the key was the flexibility. I mean, we did very well after the pandemic, but in the recent period, what happened was because growth was recovering well, the policy focus became reaching that 4% target. That this MPC, because of the supply shock, the supply chain bottlenecks, etc., has not reached that target. So that inflation was falling, real rates were rising. There was monetary, financial, as well as fiscal tightening in a election year. So I think what happened was that we lost that flexibility in inflation target, and we saw the slowdown in the economy. And there is a debate currently, I'm sure many of you are involved in, that is the slowdown structural. There's a belief that it has to do with India's underdevelopment, low consumption, etc., a lot of inequality. But I've been arguing that it is cyclical, not structural. And because we saw that interest-sensitive components of output fell, we saw the same thing happen in the 2010s. And for the structural view, the data shows that consumption growth is actually rising over the past year compared to the past. So that K-shaped recovery, and that there's some structural sort of disadvantages in consumption is too low in India. The evidence coming in does not support that. And so the flexible, appropriate monetary approach is to counter. Unfortunately, India's opening up is coinciding with a lot of external shocks. So policy needs to counter these shocks and smooth domestic growth. And then the big experience after the pandemic was, these days people are worried about Trump or trade war, etc. But Trump can't be more serious in the pandemic. Pandemic was worse than Trump. And post-pandemic, India was one of the countries with the highest growth, brought inflation down, etc. So the argument I'm making is that we have enough domestic diversity and buffers to smooth external shocks, whatever they are, even if they are Trump-related. And it is very important to do that, because the latest data shows that employment, one of the big kind of lacuna in the Indian growth story, that employment, good jobs are not rising fast enough. Latest number of surveys are showing that in these last 3 years, employment growth has also picked up. I think firms have begun to offer more jobs where they see certainty. So there is a view that Trump, you should be careful. The traditional view is emerging markets should just become more cautious, tighten when there's global volatility. But my argument is that's exactly the wrong thing to do. And that's an example of how we need to be different from emerging markets and from seeing what our ability is, what the context is. So I'll focus on 4 examples, and we may not go through it all depending upon time. But the first is that macroeconomic policy needs to adapt to structure and shocks and draw out the implications of this. That a problem for emerging markets is last year I was chairing one T20, Banu was also there. So this issue of finance for green, for emerging markets, that not only do we get 1/4 of what is there globally, but it's 4 times more expensive. So how do you decrease the cost of borrowing for emerging markets? And the argument is that asset volatility and high risk premium, you can bring these down. Those are responsible for higher spreads. And then what are the key monetary transmission channels, and then issues in regulation. So coming to the first one, adapting to structure and shocks. I think in India we used to talk about supply shocks. We all know that headline is more than 50% food and oil and so on. But earlier this was regarded as an emerging market issues. But I think the pandemic has made it clear that it is supply shocks affect inflation worldwide. It's become more sensitivity to that. And the issue is that this opens the door to monetary fiscal coordination. Earlier, it was always that central bank independence means that you don't, that central bank is responsible for inflation and you try to restrain the government, which is pushing too much for growth, etc., and creating inflationary pressures. But fiscal action can be more effective in overcoming different kinds of supply shocks, while in an economy like India, monetary policy has a stronger effect on aggregate demand. There are limits on fiscal spending because of high debt, etc. But we have large youth who are buying on credit now, housing demand, etc. A large informal sector that borrows. So that is one major effect that monetary policy has on aggregate demand, and the other is that it anchors inflationary expectations. As we talk about this 4% target and tolerance band, we are seeing that inflation has come down. People are internalizing that in the contracts they write. That's the anchoring function. The other set of shocks is the capital flow surges. We're seeing it again during with this Trump trade, which raises the risk premium costs that we have to counter. And then, as I was saying about the structure, I've already discussed that, aggregate supply and aggregate demand, broad characteristics. So in this situation, there's a lot of research that I'm not reporting here that underlies this. I've done a couple of research papers on this where we estimate what is the neutral real rate of interest. And there is an argument that in India, because you have higher growth, in transition, emerging markets have higher growth, the real interest rate rises with growth. Recently, the RBI had an estimation where they raised their estimate because growth had risen. But in this paper, I showed that where this growth is actually absorbing people who are at a lower level of productivity and therefore raising productivity. And also the experience, because you see in the 2010s that whenever the real interest rate was much above 1%, you had a slowdown. We say, why hasn't investment taken off? We saw that investment used to collapse. So the experience as well as some theory. So what this such a real rate would imply is that when there is an external shock or there's inflation or something, if you are ensuring that this is near unity, your policy is de facto counter-cyclical. And because monetary policy has to anchor expectations and not prevent excess demand, so if there is fiscal coordination in long-term, short-term, during the post-pandemic, we saw counter-cyclical use of oil excise, which brought down inflation. That's a short-term, but long-term is really improving supply conditions, chronic sort of cost push and supply bottlenecks that we have. So, and then moreover, a conservative fisc, where we see the fiscal deficits coming down, India is one of the very few countries where that's happening, allows itself reduces risk premiums, etc., and allows monetary policy to be feasible, to be accommodative, and that makes for a much higher multiplier. And this is another, I just want to flag where markets understand things differently. Most analysts are always talking about the waning fiscal impulse and how this is bringing down India's growth. They say, what are the growth drivers? How can growth increase? When the government is contracting total expenditure, deficit finance total expenditure. But again, there are papers which show that quality of expenditure matters much more and can really raise growth. So, as I said, the recognition of the importance of supply shocks has enabled, there's a lot more discussion on monetary fiscal coordination and how this is compatible with central bank independence. Because if there is this, that monetary policy affects demand more and fiscal policy affects costs, then coordination can decrease the cost of disinflation. But then there is a view that, and especially when I was discussing this with some, gathering of South Central bankers, they are very suspicious of their governments. They tend to spend too much, there's so many political pressures, it's short-term view. But then I think the Indian example shows that there can be enforcement mechanisms that work. So I like to call them carrots and sticks. One carrot is that whenever growth is high, and in an emerging market, if you can smooth growth, you naturally have high growth. But in the past, growth has been volatile. Our catch-up period in India compared to China, we've had very volatile growth. Then that, the real interest rate less than growth, that brings down deficits and debt ratio. That does not work so well. So if you are able to, we've seen India's debt coming down is partly because of high growth, which is greater than the real interest rate. And the other thing is that interest payments, many of us don't realize that the 25% of central government expenditure goes on paying interest. Right? Debt comes down, interest rates come down, then that releases so much of funds for productive expenditure. So that is a set of carrots for the government to comply in policies that can bring down interest rates and keep growth high and smooth. So why is it consistent with central bank independence? It is because the policy repo rate is conditional on inflation. When inflation is persistently above the tolerance bands, as we did during the Ukraine war, we found this in the MPC, then we raised the repo rate in very rapid steps, 50 BPS at a time. So this is the second enforcement mechanism. And here also in an open economy where you can have foreign outflows when things are not going well and there is worry about stability. That's another enforcement mechanism that forces fiscal conservatism, at least at the center. And the argument is that if you have a positive low real repo rate, then automatically whenever inflation rises persistently, that means that your nominal repo rate will rise to maintain the real repo rate. So in that sense, monetary policy inflation targeting is credible. We saw that happen when inflation was persistently high after the Ukraine war, repo rates were raised. So just this understanding that there will be an instant reaction, inflation is not going to be allowed to sort of set in, is enough to make the inflation target credible. And we've seen in this period that core inflation fell to a historic low of 3%. Yeah, even though there were supply shocks. I'll just show, and the interesting, I'll just show a graph that the kind of shocks this MPC had to deal with. That dotted line is WPI inflation. And we saw that during the period of the first MPC, oil prices really collapsed. And that helped bring inflation down. But we had to deal with that large rise in oil prices and other kinds of supply chain bottlenecks. But despite that, you see the headline, which is CPI, the range of movement has decreased. It is staying within the tolerance band. And core inflation, which is a longer-term trend inflation, which does not include these volatile commodities, etc., is also coming down even below the target. Yeah? So the second example, so this is about how the freedoms you have when you adjust policy and how it can benefit. And I think I would welcome more research on this, but my view is that this adaptation helped us do well in the post-pandemic period. Then this issue of volatility, and this is related to Shri Subramanian, worked a lot on open economy issues, that's why I selected this. And also because there's a very vital and passionate debate in India newspapers and media currently. The issue of, because we saw this, that whenever there are global risk-offs, which means foreign portfolio outflows go away from emerging markets, go back to the US. And then you see pressures on the rupee, and you see if the dollars are being sold, reserves are going down, then analysts get very worried. They think that emerging markets, you lose all your reserves, you should let the rupee go, don't intervene, etc., etc. But you cannot have a pure float in an emerging market. If you have a pure float, that definition means reserves should be zero. You're holding large reserves. And these same analysts are very happy when reserves are increasing. They say nothing. It's only when reserves are going down that they get worried. But we have seen in the pandemic period, the Ukraine war, even the Trump trade, now we are seeing that Trump trade reversing, dollar index falling and FPI coming back to emerging markets. So you have to hold your calm in those periods and use some of the reserves, a mixture of depreciation, so that you're compensating for inflation differential, you're making sure the real exchange rate is competitive, and then some reserves to reduce excess volatility. That is the RBI's long held. Dr. Rangarajan was the governor who started that policy, and it has worked very well for the economy. So, and moreover, a lot of research shows this UIP. This is again, I want to emphasize the way emerging markets are different, or specific emerging market is different. Like for Japan or Europe or UK, the interest differential with the US is very, very important. As soon as the US is changing rates and they don't change, you'll see large capital flow movements affecting their currency. But in India, the interest-sensitive inflows are very low as a percentage. The cap on debt flows is 6%, we are much below that currently. So we are not so sensitive to the interest differential, and here the risk premium, volatility, growth, etc., are more important for foreign inflows. So this view that Arvind Subramanian, there's some economists who want to bounce on any little thing that goes wrong and blow it up. So when the strong trade happened, they pointed to this. If you see this bottom figure, you see that in the recent period there's very little exchange rate volatility. Yeah, so they said the rupee has become a peg. IMF also said this, there's too much intervention, and this is creating real appreciation, inviting a crisis, and this is what is happening, rupee is going to collapse, etc., etc. But if you look at this more closely, then you see in the same regime, there was large depreciation before that period, during the Ukraine war. So opportunistically, when there are outflows, you let the rupee depreciate. Then when there are inflows, you're building up reserves. So there will be less volatility of the rupee. But you see in the period after that, the daily graph, which is above, the recent period, even that period when there was very little movement of the rupee, you saw what I call a crawling depreciation. The rupee was depreciating, although the RBI was intervening buy and sell in the market in a narrow range, there was very little daily movement. There was crawling depreciation. And again, during the Trump trade, we saw larger, but now it is reversing. Yeah? Just as earlier, these periods when there was depreciation, it eventually reversed. Yeah? And again, this is showing that the spreads, a major pressure we faced from analysts in the MPC was that the interest rates are falling in India too much, and spreads are falling with the US, and this is much below historical levels. So these lines show the spreads in G-Secs and repo rate compared to the Fed. And we do see that they did fall in 23, 24. 22, they were the lowest, compared to historical levels. But this graph shows that in 22, you saw spikes in equity inflows as well as debt flows coming into the economy. So, and there is a lot of research also which shows for emerging markets this UIP does not hold. We don't have profit capital ability for debt markets, debt flows, etc. This argument that the real rate, the rupee had appreciated and that caused the crisis and reduced demand, it's not true, because this graph shows two different indices of the real exchange rate. It shows that the rupee actually appreciated in the 2010s, yes. But in the post-pandemic period, it's flat, it fell on one index. Yeah? So there was, as I said, there was crawling depreciation. Our inflation differentials were lower, so the small depreciation that took place was enough to maintain the real equilibrium exchange rate at a value of 100, which is an approximation for has worked well as an equilibrium real exchange rate for India. Again, some deeper research suggests reasons why that works, that is appropriate for the Indian economy. We don't have time to go into that. So overall, we should expect that as productivity rises and costs fall, the really expected effective exchange rate should appreciate, especially if risk premiums and volatility fall. And emerging markets, some of our neighbors in this post-pandemic period, in Sri Lanka, there's 70% inflation. Again, this meeting of central bankers, the Bangladesh and Mauritius central bankers, they were saying, IMF told us, sell your reserves. And then the currency just sank. Yeah, and when the reserves ran out. So very well to say don't hold reserves, you're intervening, let the market determine. But in emerging markets, there's too much volatility. And again, the research shows that this UIP, the risk premium, is a function of this volatility. And in India, that risk premium had come down when the rupee was much more stable than other countries. So the careful policy choices RBI has made, Dr. Rangarajan at the lead, has given us a lot of degrees of credence to respond to domestic needs and to deal with external shocks. And I think that the future looking at eventually as foreign inflows come in, they should be allowed. Indonesia had 40% their foreign inflows in their debt markets, local currency borrowing. So during the taper tantrum, they had very large interest rate volatility. Our volatility was much lower. Yeah? So the idea is that as markets mature, this level of cap for debt flows has gone up as the size of the market. Absolute amounts, much more is coming up. So in the future, there will be much more freedoms, but it will reach a natural cap of about 10%. It should not be allowed to pop domestic market. It should not be allowed to become too large, because then it's the tail that wags the dog, and you lose all domestic policy freedoms. Yeah? Then this monetary transmission issue. There is a view that a country like India, dualism, informal sector, monetary policy, and interest rates don't work. So you are talking of a regime which is ineffective because there is no transmission. But it is true we have a large informal economy, but with 1.4 billion people, our formal economy is larger than that of UK or Germany or, so we also have a very large formal economy. And because we have more young people, as I said, as well as an informal sector that depends on borrowing, lower income households, a lot of sensitivity to interest rates or the cost of money. And moreover, as the modern financial system develops, then money becomes more endogenous. So one reason the RBI moved from monetary targeting towards the multiple transfer indicator approach and then on to inform inflation targeting was that money demand becomes unstable. So you cannot control the money supply, you cannot control the money supply, you can't control it as much as you would like, and you're not able to predict or affect outcomes as effectively. And then there is a view that interest rates don't work for whatever policies, and therefore you should use the exchange rate as your transmission people. So look at as your mechanism. So the people who are most volatile about RBI is intervening too much, the exchange rate is being frozen to effect, that it doesn't work, that's the major transmission channel you have, you're blocking it. But in India, the exchange rate doesn't work well as a demand channel because our imports are commodities where there's instant price through, our exports are competitive markets where exporters are not able to pass through depreciation, and it eventually leads to appreciation of the real appreciation through inflation. Yeah. So, and as I said, the excess volatility, overshooting raises risk premium and borrowing costs. So therefore, that's not an effective channel for India. And but this first view, the degree of informality, the state at which the economy is now, I think the liquidity or the quantity of money does matter. Although the cost of money, so inflation targeting has worked well, which works through the cost of money through interest rates, but durable liquidity especially also matters. And there is a big debate over whether this liquidity should be in deficit or surplus. Then when you're in a tightening period, it's better if it is at, so we have a LAF or liquidity adjustment facility, where automatically on demand liquidity is injected, and then now you have standing balances, so banks who have surplus can automatically deposit that in RBI at the lower end of the band. So there's a view that short-term liquidity is endogenous since that is demand driven, so liquidity cannot be a problem. The inflation targeting regime need to work with prices. But we are still in a place where we have very large exogenous durable liquidity shocks, which can be due to cash leakages into the informal sector, build-up of government cash balances, which happened a lot over the last year, elections and governments were not spending, which created a lot of tightness in liquidity. Capital inflows and outflows, that also, because government securities and capital, foreign exchange reserves are the major components of reserve money. And then moreover, in the Indian system, only banks can borrow at the last window. But now the financial sector is really diversified, and banks are very reluctant to lend based on short-term liquidity borrowing. So lending goes down in the NBFCs and the informal sector, MFIs, they really get squeezed for liquidity. And we've seen that periods of very tight liquidity have led to slowdowns in the past. So it would seem that here maybe it's better to keep either get in a position where you can forecast better these changes and compensate faster, or keep durable liquidity somewhat in surplus, varying degrees depending on whether you're accommodating or not. So this chart just shows you that the reserve money, which is the blue line, this is growth of the reserve money, which is the money the RBI creates, has fluctuated a lot. It's volatile, and I think that was one of our problems. That, for example, during demonetization, huge liquidity in the system. So then extra tightening, pandemic, huge liquidity injected, then extra tightening. So this volatility, and we see that broad money and credit follows reserve money. So reserve money is durable money, this is not laugh liquidity. So that tends to drive other types of credit in the system. So to say that only the cost of money matters is not correct. And then is this driven by foreign inflows? But we see in recent period that they've worked out these swaps and forward markets and so on. So they can adjust liquidity, durable liquidity, even though a major part of the RBI's balance now is made up of US government securities, not government security. There are limits to own more operations. So there are instruments to compensate. And one more thing is that the fluctuations are still large, but they're coming down in size. And this is part of the maturing of financial markets, that you can adjust more smoothly with less volatility and shocks to the system. So this is just a calculation of real interest rates. Treasury bill, well, the repo rate is set by the MPC, but the treasury bill, short-term treasury bill rate captures what's happening in the short-term market. And you see that during period, this dotted red line was higher than the repo orange line, or even the treasury bill, which looked at 1 year ahead inflation, because 1 year ahead inflation was falling. So what happened was, because of liquidity tightness and not responding to its future falling inflation, real rates really went above 2%. And that contributed to the slowdown we had seen in 2024. Then, I don't know how much time I have. So, enough time? Yeah. Okay. So a little bit about regulations, and here also there's a lot of difference between perception and the reality. And this was also a very educative experience living through the post-pandemic period. Because we have a lot of disbelief or suspicion about the financial sector, that it's all stuffed full of crooks who are out to do all sorts of, or whatever, there are a lot of weaknesses. And it is true that pre-reforms, there was severe financial repression. The government was really using the financial sector to finance unsustainable, unviable, unprofitable public sector investment. And so reforms were about reversing this, moving from controls to markets. Again, Dr. Rangarajan was really involved in the conceptualization. RBI set up an Ashima committee, and they're very, and what was interesting here is that, again, it was not just moving to a liberalized or a Western system. The idea that banks will take time to learn. So, for example, the Basel Committee, the international regulation focused on these internal risk rating based on VAR models. But the global financial crisis showed that there are severe weaknesses in that, and banks can manipulate it to undercapitalize. So our banks were saved that. The problems they had was something else. And through the 90s and 2000s, we saw that NPAs really went down, public sector banks became competitive. But then the 2000s, because development banks had been shut down and commercial banks were pushed to lend for infrastructure, where there is a set liability mismatch. When the global financial crisis happened, external shocks, and many of these loans became NPAs. So these are very different sources of problems, and the solutions have taken place, but problems recur. So that just added to the perception that there's something basically wrong with public sector banks, ownership, government intervention, whatever, and the solution is privatization. Very often from analysts, from foreign-based economists, you hear this advice. Yeah? And especially in the post-pandemic period, because we're just struggling with a decade-long battle with NPAs. So the view was that the pandemic would make matters much worse. And I had joined the studying NPAs, doing some academic papers on that. So I got an offer to join the IGIDR bank board. And that had the largest NPAs. So I joined it just to study it at the ground level. And then in the MPC, the RBI brings out the financial stability report. They had predicted that NPAs would rise in the post-pandemic period. I said, no, it's not, because I saw how the IBC was working, there was recovery and moved towards risk-based, various things that were being done in the public sector banks. And this was actually a very surprising factor for markets. So International World Bank also said that the amazing Indian banking sector, Moody's, said the financial sector had surprised on the upside. So I think there was learning from the experience of the past. In the 2020s, you had, in the 2000s also, Dr. Reddy was the first to apply this counter-cyclical prudential regulation, much before it became fashionable after the global financial crisis. This creates much better incentives in the financial sector, and it smooths the tendency towards booms and busts. So in 2020, and what happened with the GFC was that there was too much stimulus given, it was withdrawn too slowly, that created excess and then led to over-tightening, so overreaction. This time, a lot of liquidity was injected, which was time-bound. A lot of it was automatically going to end. So, and also in last year, we saw that credit card loans are really increasing at 30%. We know that whenever anything grows that rapidly, it can be problems. So again, counter-cyclical dynamics of risk weights were raised. And so in this decade, we saw that banks' capital adequacy rose, balance sheets were very strong, financial sector, and overall, and again, the T20 studied regulation and advanced economies. We see that it's totally based on borrowers, not on entities, bank-based after the global financial crisis. So as a result, there are shadow banks, arbitrage funds move towards a less regulated sector. So for example, the inflows coming to emerging markets used to be cross-border loans from banks. Now they are from shadow banks, from non-bank financial institutions. But in India, we've always had regulation and use of prudential. In general, there's IMF research which shows that prudential regulation is used much more in emerging markets than it is in advanced economies, where the focus is always on capital adequacy. But in India, in emerging markets, you need to use capital and you have all kinds of other regulations. So following that regulatory mode can result in over-regulation in the emerging market concept. So overall, here we have broad regulation, lower systemic risk arbitrage, balance between government ownership, which can cause discretion delay, governments, and markets, which can cause excess volatility. And in general, I would say that the problem is not ownership, but independent boards, better corporate governance, which is something that has really been emphasized over the last couple of decades in India. And then if you have this, diversity is stabilizing. Because the problem with the financial sector is everybody follows each other to lead to excess volatility. So here you have people who have different business models, like the Jandhan Yojana, the no-frills accounts that would not have grown in such a big way without. But at the same time, the government pushes these banks to do these kind of schemes. They're giving direct financing rather than letting it hit. So you have banks like Kotak also making, working towards financial inclusion now. And we're seeing this improvement steadily that default rates, LabFit has some data which shows default rates have gone down in infrastructure. So they actually need less risk weights now. That lowers the cost of infrastructure loans. And we have much more diversity in the financial sector. Non-bank sources of finance have gone up quite a bit, bonds. So there's less pressure on banks and therefore, less problems in the future. So this table just shows the kind of forecasts that were there for just after the pandemic. The RBI FSR, for example, forecast the gross NPAs would rise from 11 to 15%, and the actual proved to be 9.34. So the degree of much better performance than expected. You see this is a picture, a graph of NPAs, and you see that the rise in the post-reform period, they were high because of financial repression and non-commercial types of borrowing. That really came down. And then it rose again because of the push for infrastructure financing, etc. And it rose for very different reasons. So I'm not saying that things are perfect in the financial sector. We still have very large spreads, all kinds of risks. And MFIs, for example, have, recently with the tightening, has shown that people are repaying by borrowing elsewhere, taking multiple loans. And NPAs have gone up once this has been stopped. And in some cases, when NPAs are more than double digits, it can be a serious for that entity. But then these loans are small compared to loans made for infrastructure companies like Kingfisher and so on. So it's not a threat for the system as a whole. There can be regulatory capture where, financial sector just doesn't understand counter-cyclical prudential regulation. They think things are going well, everyone is doing well, why are you tightening? You're just adding up burdens and reducing growth, etc. So against that, but the idea is that you prevent problems down the road, by not overstretching now, so you can grow smoothly. And very often for example, banks are really resisting a rise in interest rates. And most bank analysts would never, because now our MPC listens to gets news from everywhere. So we thought, and really the bank analysts were not, even though there was a slowdown, they would say liquidity, we want liquidity, that would help them. But rates, because deposits were not growing as, all the deposits are higher than loans, but the rate of growth. And so they were afraid that their margins would fall, they would not be able to lower deposit rates and would be forced to lower loan rates. But actually, you see bank profits remain strong because when growth recovers and they're able to lend to corporates and better quality loans, their profitability goes up. So on one side, you have that kind of regulatory capture. On the other side, you can have over-regulation in the Indian context. So the budget this time has talked about simplification, ease of doing business, because the view is that there are fundamental problems in an emerging market, informal economy, all sorts of hidden issues, extra suspicion, to do everything possible. Then you can end up doing too much. So that also happens sometimes. You can have multiple regulations instead of minimal regulations. So overall, a lot of improvements in the financial sector has also improved. But there's possibility for further improvements. And in particular, sensitivity to the trade-offs between instruments. For example, what happened last year was this prudential tightening, financial tightening because liquidity tightening, as well as fiscal tightening, and monetary tightening because rates were high. So now, if you are going to tighten prudential regulation, which is required to reduce lending in sectors that's growing too strongly, then you should make sure aggregate liquidity is large. Bank lending to NBFCs fell from 30% to 8%. So what is the, you should not, so the idea is that you have to fine tune use of these instruments. You don't, that volatility has to come down. Tighten without really making things crash. So I think, and sometimes there are aspects of bank lending to NBFCs, for example. The RBI is worried, the bank regulators worried about interconnectedness. So one rationale for the increasing bank risk rates on NBFC lending was that we're borrowing too much from banks, which is the 1/3 from banks, 1/3 from markets, 1/3 from abroad, and so the risks are spread. But then there's also so the fear of interconnectedness in the financial sector. But then there is an efficiency argument because NBFCs are very good at distribution. So the idea that they are lending in risky ways or no, they are increasing financial inclusion. They have knowledge of the borrowers on the ground, and therefore they can do better risk-based lending and can assess that borrower better. So maybe we need to think like in the US Fed lens on all kinds of securities, to all kinds of sectors. We need to think of making liquidity more easily available to other sectors. Stop. Thank you.
Thank you, ma'am. The floor is open for questions. Please raise your hand and we'll pass the microphone to you.
Good evening. So my question is, developed countries like USA has an inflation target of 2%, while our target is 4%. And I have seen economists argue that the US inflation target of 2% is arbitrary. It doesn't have any credible rationale behind it. So I want to ask what is the rationale behind our target of 4%? So before that, I used to think that the economists used to look at the short-term lift and look where do we minimize unemployment and inflation. So I would like to ask what is the rationale behind 4%?
Collect some questions. Any more questions?
A great presentation, madam. If the mechanics of a certain policy prescription, which includes changes in interest rates or trying to sort of change certain rules and regulations by which markets are, the trajectory of markets have changed. If the mechanics of things like inflation targeting and exchange rate volatility and all that, if they are negatives in the sense that we are merely given explanations of how things work. If there's an increase in interest rate, we immediately correlate to decrease in demand, which will translate to a certain expected result in a market. But that is merely an explanation. Things don't operate under the clock. So, because of the fact that nobody really knows as to how things work, specifically in the context of what you would be doing and the kind of result it would yield, then how do we truly know if a policy has worked because of the intent of the policy or in spite of it?
So, I read a paper with Abhishek Kumar on whether Indian inflation is demand driven or supply driven, which I found very interesting. And what I found was that it's really important information to have as a policymaker whether inflation is demand driven or supply driven. Because if it is, cost push, you don't want the monetary policy to intervene much. You want more fiscal stimulus for that. And I wanted to ask because research on that is more retrospective than it is forward-looking because you can't do that. But is something happening within the RBI, within the NBC that there is some real-time forecasting or understanding or decomposition of whether inflation is more coming from the demand side or supply side? Because you want to get a jump on it. Because in the paper, I think you wrote that any amount of inflation is having a long-term effect on the output. So you want to deal with it as quickly as possible, given that there is a sort of transmission delay as well. So is there something happening that is more real time of that decomposition?
Give it in front.
It is sometimes suggested that fiscal stimulus can help the central bank in reducing the inflation through supply side mechanisms. So, in reverse, can the fiscal consolidation leads to high inflation and along with that, can higher interest rates at that time will worsen the situation? And one more thing, so we always say that higher interest rate leads to lower inflation, but there is also cost channel operating behind that, where the higher interest rate can also lead to higher inflation. So how much that is prevalent in the Indian context?
Okay, I think now I should forget the question. So why 4%? So in India, we have a tradition inflation was around 8 to 10%, 70s. Can you hear me? 8 to 10% in the 70s. And the idea is to bring it down gradually. And also, if you are in an emerging market where things are not so smooth, supply chain bottlenecks, etc., you can have large changes in relative prices, and they would affect the aggregate. So inflation has come down from 8-10% to 6%. To bring it down gradually, because if you want to bring it down immediately to 2% or 1.0, it's not. In fact, the people think that in India the target should be a little higher to allow more relative price adjustment. Yeah, but I think that a lot of this is really, once you really factor in that the average inflation is 4%, then a lot of contracts are written with that in money wage adjustment, rental contracts. Then it becomes costless in a way. And relative price changes don't affect that because they're transient. And more and more regulators internalize that you don't give MSP, for example, that you don't give really high trend increases in prices. Yeah? So, and the second question was about how do you know what works when there's so many factors and they can act in different directions, right? So here, I think theory is very important, understanding of behavior, what affects behavior, and the structure. Like, okay, you have a lot of young people, and try to say that, no? And they're buying things on credit. Yeah? And what matters there is the real interest. And then the reasons why you don't think.
Change the mind.
So I think in that sense, you need theory and data and knowledge of structure and common sense. all working together. And you're lucky to get things right. And you are right, you never get credit for what goes right. Because people will always say it was due to something. Yeah. And this third question is whether it is supply or demand depends inflation. I think that decomposition that Abhishek did was without imposing anything and just looking at what is it that affects inflation the most, what kind of shocks. And he found that in the past it had been supply side shocks. And that we know anyway, but this was a nice way of sort of proving it or showing you. But at the same time, you can have periods, you can have, as soon as supply side shocks become persistent and they get written into contracts, or money adjusts endogenously, then, I think Newton Friedman said that inflation is always finally a monetary variable. So if you're tightening, keeping your money supply really tight, that rise will not take place, but instead you'll have a very large output sacrifice. Yeah. So the forward-looking aspect is that you know that monetary policy works with lags. So you look in terms of expected inflation. So if you read the MPC minutes, the RBI data releases, they always give you a pan chart. There is uncertainty there, so you have expected inflation and the probabilities around that. And the reason why we saw this last year was that expected inflation was going towards 4, but the repo rate stayed at 6.5, liquidity was tight. So the real rate went up much higher than, and that real rate really affects interest-sensitive demand. So, or expect decisions made on forward-looking inflation. Then the last question was about whether interest rates raise costs and so on. All that is there. That can be a part of the cost push. So that is why, that's why I talk about a small, low real rate of interest. But there's a lot of money illusion in this. People think that high nominal rates, retirees, for example, say repo rate cut is really negative for them. Why? But then earlier rates were at 14%, but inflation was at 12%. Right? So in real terms, they got much, much less. Yeah? And so that is why I think that focusing on a low real rate allows you to balance these different considerations. Because you need the real rate to be positive to prevent inflation really taking off, sort of nominal anchor in the economy. Yeah? But that means that the cost for borrowers is not going to be that high, but the reward to lenders is not going to be too low. So you tend to balance off these conflicting interests and possible macro effects. Thank you. Any more questions?
I can't stop. Just so everybody hears. Hello, ma'am. I'm Arya. I'm a faculty here. I teach macroeconomics and money and banking. So this is a question which I often asked at the research front, as well as in the classroom. It's about monetary policy independence. Suppose if a different country, like say US or something, if they are increasing their interest rates, and if we decide to increase the interest rate, will it be really to curb capital outflow, or is it really, or should the domestic country be more worried about domestic inflation? Because for controlling inflation, you can reduce the increase in your risk premium, and you can provide more liquidity in some sense. So there is always this trade-off. So I just want to look at your take on it.
So again, the answer is it depends on the circumstances of the economy and so on. And as I said, the issue with interest rate differentials is that capital flows are very short term and very fast. So if you're totally open capital account and you have a large share of debt or fixed income flows, then you have to factor in that it's going to lead to a lot of exchange rate volatility. Now, Japan did not follow the US and it faced the pressure on the yen. because that is what they thought was appropriate for their economy. But in a country like India, I'm saying that we have the degrees of freedom, that the capitals are not so, the share of interest rates in capitals is not so large. And we can, and this is a big issue in the NBC, you know, after the Ukraine war, wherever there were outflows, or wherever the Fed changed rates, how can you raise rates before the Fed? How can you cut them if the Fed is not cutting, etc., etc.? Because I think a lot of foreign inflows to India come from the US. They're very centered in what the Fed does. But like the graph said, I tried to show you that our inflows, actually in the period of lowest interest differential, you had a large sharp rise in equity inflows. Because we see this reversal after a period of risk off, it becomes risk on, and then they all come back, and they don't bother about the interest differential. So we need to follow our domestic needs and not worry about what the Fed does. We have the degrees of freedom, we have the reserves to smooth any volatility. And we've seen in the past there is this reversal, so we should not overreact in periods of risk off and so unnecessarily raise our rates and hurt our domestic sector. Any more questions?
I have a
Okay. Last two.
I want to request you to get control of the mobile app who offer loan, because they are like really badly affected the youth. Because if you are 18 years old, you have a PAN card, you can open a app, you can get minimum of 7,000 rupees loan, and you can get it in 15 seconds. So the friction is really less to get the amount, and the interest rate on that is 28%, 31%. So just I want to request you to get, and there are many apps. You can download 5 apps and you can get 35,000 and 35 interest rate on 35,000 and 38%.
Yeah, that is why you need regulation, and you also need supervision, because the financial sector makes money by inciting people to give in to their weaknesses. And private sector, whether it's in a t-shirt sale shop, they really pester you, they really get after the customer. So I think not only loans, it's also gaming or the short-term trading in the stock markets. They've done something there, like raised the threshold before you can enter. So maybe they can bar, this app should not be, there should be a certain age under which you cannot get it. Really, so this sort of, I don't make this policy. But, so you have to, you must write to the regulators, you must put it out there. And I think the government and regulators do listen to what the public wants. There are people who say that, why are you interfering with our freedom? If I can get loans, how dare you control it? There is that view also. It says that you're regulating too much, you're reducing my freedom. So if you raise your voice that this freedom is hurting us, we want to take it away, I think it will be listened.
We'll take the last question from you.
Actually, I have 2 questions to ask them. So it's like regarding now, like NBFCs, there are some recent news.
I can hear you speak.
Yeah, so recently, like NBFC, there are some recent news, right? Like earlier the RBI had increased the risk weights, like the lending to NBFCs, but now they have cut down the lending. And apart from that, like IMF in the recent report has also come, have been saying that the NBFCs have increased. I mean, they have given a bond that NBFCs are very more to the power and the infrastructure sector, which is like fast growing sector, right? So, like, what do you think? And apart from that, like, given now the, after like more than 20 years, they are considering the proposal to increase in deposit insurance. So, what like the risk like that the government has promised to like consider these next 2 months, like one of the speaking on their risk rate and then that proposal to increase the deposit insurance.
Yes, so I think it's about fine-tuning regulations. You don't want, we have a very comprehensive regulation for NBFCs. Strongest regulation is on the systemic NBFCs, the really large ones, because they can have multiplier effects on the financial sector. And then by scale, yeah? But I think for NBFCs, they also have self-regulation and their own realization that if you have better accounting, you will get, you'll be able to borrow on easier terms, and etc. So those improvement in governance and standards is very, very important. So earlier the RBI had raised risk weights. This led to a drastic reduction in bank lending to NBFCs and a fall in bank NBFC loans. It was too drastic. And that was at a time when loans were growing at a very rapid rate. Now the loan rate growth has slowed, right? So it's counter-cyclical that you adjust this weight, that you decrease it somewhat. You haven't decreased it to what it was earlier, but it's fine-tuning from looking at market outcomes, which needs to be done, right?
But IMF has it can cause systematic.
No, IMF has always been wrong about the Indian economy, and I don't think we need to worry so much about what they say. I don't think there are any systemic issues here, because as I was quoting the snapshot figures, we are seeing that the infrastructure sector is much more diversity in the types of financial sector lending, and these annuities for the NHAI, etc. And not the earlier. So people also, it's very human psychology which affects the IMF also. The once bitten, twice shy. Or you always expect the past to repeat, and you don't realize how things have changed. So why was it surprising that bank balance sheets increased? Ingrained that there are problems in the banking sector, there are always issues, they always get into trouble. But we're seeing a real strengthening there.
Thank you, ma'am. I now invite our chairman, Dr. C. Rangarajan, to deliver the presidential remarks.
Professor Ashima Goyal, Mrs. Subramaniam, Dr. Barmurthy, and friends. This is the first Subramaniam Memorial lecture. We are grateful to Mrs. Subramaniam and the members of the Assembly for endowing this lecture in Madras School of Economics. I'm also grateful to Ashima for accepting our invitation to deliver this lecture. The lecture that we listened to just now is very thoughtful and scholarly. In fact, she touched on many issues relating to macroeconomics, monetary policy, fiscal policy, and so on. I must say that I have known Ashima from the time, almost from the time when she joined the IGIDR many years ago. And she has written a lot on monetary policy. In fact, I find there are very few monetary economists in the country. A lot of them are general economists who are opposing this monetary economy. But people who have studied monetary economics and written on it and researched on it are very, very few. I'm happy to be here today with us. I don't want to comment on all the things that she said after this evening. In fact, it requires a lot more of introspection and thinking too. But there are a few things that I would like to commit. It's important to realize also the evolution of the creation of the flexible inflation targeting scheme. Many people do not realize that until late 1970s, the government of India did not have a revenue deficit. It is only late 1970s and during the 1980s they had large and growing revenue deficit. And throughout the 1980s, the Reserve Bank of India was fighting almost with the government to reduce the deficit. In fact, the problem was twofold. Not only was the deficit high, but also the deficit was being monetized. I think that was the critical problem. And as we moved on in the early 1990s, as part of the reforms, we put an end to, she made a reference to that also, to the system of the issue of without treasury bills, which in effect essentially monetized all fiscal efforts. So that was put an end to. But as we moved on, we have the other problem also, the size of the fiscal deficit. Monetization of the fiscal deficit we tried to curb because of the reform that we introduced in the early 1990s. Then came the fiscal responsibility in the budget management of 2002, something like that. And that postulated something regarding what the fiscal deficit of the center should be. I must say that that rule, that Referendum Act, has been observed more in breach than in observed. In fact, in the long history, there was only 1 year in which the central government deficit was increasing. Or in all other years, it was much higher. So what we are moving is towards reducing the monetization of the fiscal deficit, reducing the size of the fiscal deficit. At the same time, we also moved on the Reserve Bank side. It was done much after he left. And that was the flexible monetary inflation targeting system. She also emphasized the word flexibility. I mean, I think the most important thing is that the scheme that we adopted is different from many other countries. So we said 4% should be the goal, but given the flexibility of plus or minus 2%. Now, somebody asked the question, I think, about how we derive the 4%. So, the first time this was mentioned about having 4% as an acceptable level of inflation was in the Dakshinamurthy Committee report. We wrote in that report that looking at the frictions in the system and to take care of the imbalances in the system, we get 4% should be appropriate. We did some little bit of research at the time and got the 4%. But basically, many people have studied it, and I have also done some work, empirical work in this area. It does show that as inflation moves up from a low level, up to 6%, in fact, the growth is not affected. And then beyond 6%, growth is affected. Inflation of 6% affects growth rate. So that is how these the formula of 4% plus or minus can come. Now we have some experience of now the flexible monetary system and what inflation dependent system. And what are the lessons that we have to learn from this and how we can really make this system good. Ashima talked about coordination between fiscal policy and monetary policy. I think it is necessary, but then Reserve Bank on one side and government on the other side must follow some rules. I mean, otherwise there is no way of coordination. I mean, I think in the 1980s, if I look back, and the kind of verbal battles that we had with the government, it's very difficult if the government doesn't follow some rules. Therefore, there need to be a set of rules. That is what is embodied in the FRDM Act. And there are some rules for the Reserve Bank of India. If both of them follow the rules in some way, then coordination will be possible. And I agree, coordination does not mean loss of independence. I mean, independence you have, but then Reserve Bank has its own objectives, government has its own objectives. I think government's objectives are much wider. They really think in terms of not only growth. Now there is an ongoing debate in the country between developmental expenditure and welfare expenditures. I mean, this is one critical issue that has come up. Therefore, if we follow the rules, then coordination is possible, and independence can also be maintained. But then there are many issues that have come up in the operation of the flexible monetary inflation targeting system. Ashima referred to some of them. But I would say, for example, that there is no consensus yet on whether 4% is a goal, or I don't know, if you stay at 5.9% forever, is that a violation of what the inflation monetary system said? No, therefore, I think we need clarity on this. I mean, I think whether flexibility is given, because there are many things that are outside our control. Maybe whether things change, and therefore supply bottlenecks arise, and then there are other factors that would come. Therefore, the flexibility is very much needed. But then, what does that flexibility mean in terms of operational practices is also need to be very, very clear. Now, somebody raised the question about demand pull and cost push inflation. I don't know what I say will be agreeable to Ashima, but I need to say this, that as somebody said, cost push is a myth. I mean, in my opinion, cost push can lead to a one-time increase in prices. But that is not inflation. Inflation is a phenomenon of continuous increase in prices. If there's a one-time increase in prices, nobody will really bother. Now, take for example, I mean, Milton Friedman is not a favorite person to be quoted in the Indian context. But I must say that Milton, when he came to India and addressed a meeting in Bombay, made this observation. I'm not able to quote exactly the words, but I think what he said was that, yes, wage push, for example, has caused inflation. But it is not because of wage push. That is because of the mechanism which resulted in increase in money stock. Now, of course, Milton is famous for his establishing the relationship between money and prices. Otherwise, take for example, take a household. If its income is fixed in monetary terms, and if the price of one commodity goes up, what happens to the price of other commodities? If that is essential, then the amount of expenditure available, the amount of income available for other expenditures will go down. And therefore, it cannot result in an increase in the overall prices. I have quoted and written on this. And I would say that unless, if you're not happy with the word money, you can use the word liquidity. I can say, unless there is something happens to liquidity, prices cannot increase. I think there is a distinction between demand in a real sense of the term and monetary demand. I think we must make it a clear distinction. Therefore, ultimately, it is this which results in the prices going up. Therefore, I personally believe that the Reserve Bank of India, as a central bank, must be concerned with little more about inflation than growth. Because growth is a result of a number of factors. I mean, I think the fiscal policy can do much more on growth than monetary policy. Monetary policy, by lowering the rate of interest, can create conditions. But they say you can take the horse to the pond, but cannot compel it to drink. Then just because lowering the rate of interest, investment doesn't come to. I think it is Leon Tarshis who said a long time ago, many decades ago, that the monetary and the banking system is provided with efficient rates, but the accelerator is uncertain. So you can't control inflation perhaps, but then you can't stimulate growth or something as easily. When somebody asks the question whether interest rate is effective, in the transmission mechanism itself, there is an asymmetry in that. And in the increasing the rate of interest or lowering the rate of interest do not necessarily result in immediate results. But there is enough theoretical analysis to indicate that the interest rate becomes the lowering and the raising of the rate of interest has an impact on the economy. I mean, as Ashima pointed out, that in this country there are enough number of people in the kind of sectors of the economy in which the interest rate can have an effect. Therefore, she also raised the question, which is critically important. When we really talk about dilemma of the monetary policy, we talk only about growth and price stability and what is needed. But there are other factors coming, like what we have in what happened in recently. The concern with what happens to the value of the rupee becomes urgent. Then what do you do? And therefore, if you lower the interest rate too much, then it can aggravate the problem for the short term. So I personally think that the Reserve Bank of India lowered the interest rate by 25 basis points. It's 50 basis points only because of that. So this is a compromise that they have made, the balancing which they have done. Whether that is the right one doesn't know. But it is because of that balancing that was done. Okay, so I believe that there are a number of issues concerned with the transmission mechanism, how monetary policy works, and so on. I think the lecture today opened our eyes to several of the problems that exist, and how monetary authorities will have to play the game. I mean, I think it's really, monetary policy is not such a, as somebody said, or in talking about monetary policy, central banking is neither a science nor an art, but a craft. Well, I would also say this is a half-truth. It is not a craft. It is not applying well-known instruments to well-known problems. I mean, the problems are more complicated. The instruments also are not very clear in terms of transmission. So one has a lot of experience in handling the problem. And there is no one clear-cut solution to the problems that is. I think the one thing that you might have learned from the lecture this evening is that the real world has so many complications that there is not one direct answer to the question. So I'd like to thank all of you for your presence this evening here. Once again, I'm thankful to Mrs. Subramanian for endowing the lecture. I'm grateful to Ashima for accepting your invitation to be here with us this evening. Thank you.
Thank you, sir. I now invite our director to deliver the word.
Friends, I'm sure all of you will agree with me that week today, both from the lecture from Ashima Goyal and also from the presidential remarks that Dr. Raghunath has given. And I know many of the youngsters who are here. I think, I'm sure you know that there are so many issues being raised today in the open economy. And I think it's going to be, I mean, I think they're going to look at your presentation a bit more carefully and they'll come back to more questions to be answered, to you. I would like to thank Dr. Raghunath for his presidential remarks. And, anytime I hear to him, it's always a pleasure, actually. Particularly his own views on monetary policy and also fiscal policy and the kind of thing that comes out from his talks is always very encouraging and very enriching for all of us. And I'm sure you also enjoyed this presidential remark. Thank you so much, sir, for that. I also like to thank Ms. Ashima Goyal. She's been working on this topic, I think, emerging market macroeconomics for a long time. And I'm sure she has gone through the whole evolution of whole emerging market economies. I was just thinking aloud that every decade we have some tantrums to be faced, particularly emerging market economies, and I think we are used to the tantrums. We had very recently paper tantrum, now we have tariff okay, I don't want to use the word, but tariff tantrums. So I think in that context, as Dr. Raghunath pointed out, there is no one clear solution for the complex issues. And again, thank you so much, Ashima, for raising so many issues in the presentation. It's a very vast subject, so I'm very thankful for your detailed presentation on that. I also like to thank the family of Shri Kandaswami Endowment. Madam is here and his family is also here. And especially to the daughter Meera, I think, who has been helping us and guiding us in this event. And I'd like to thank the whole family for this endowment lectures, and also look forward to working with the family in the future also. I'd like to thank all the guests who have come from outside MSc. We have one more lecture happening the next week, Dr. Chelaya Memorial Lecture, that will be on 20th March. I look forward for your participation in that lecture also. And again, I'd like to thank all the students, particularly the students who asked the questions, very brilliant questions. I hope in future also we'll keep asking many more questions to the visitors, so that it will be very interesting for all of us. And thank you so much for being part of this event. And again, let me thank my office staff, Rupal, for this event, moderating this event, and the students who helped me preparing this event. And thank you once again. And let's join for a tea.
Have the national.
Okay, there's a national anthem. Thank you so much.